Hello, everyone. Jeff Fratarcangeli here, Fratarcangeli Wealth Management, for another call to action market update that we always try to navigate and bring us together when we see some crossroads as to what's happening in the world with the investments, with the economy, with the change of the guards coming in January 20th, and a number of other factors that I'll talk about. But before I do, a little bit about Fratarcangeli Wealth Management that was established back in 1995, and we are now today 30 plus employees in 4 states with the objective and the goal of guiding and counseling our clients through the number of sophisticated as well as what may appear to be decisions that are easy to make sure that we're thinking through the bigger picture of what we're trying to achieve today for the near term, the long term, and the legacy. What is going to allow us to have the most optimal outcome while we navigate those decisions, ranging from investments to estate planning, to tax planning, to working with companies and working with individuals and working with family offices of the like. And here we are today, working with all sorts of folks across the country that meet those alignment of needs. And we're a custodian here at Wells Fargo as our bank and our institution that we utilize for all the different benefits that they bring on the platform for cash planning and as well leverage. We're an independent firm that also has access to many different other institutions and folks that can be utilized for our clients' needs. We have a network of professionals that we can call upon on the front lines that have been accrued over the multiple decades and for their particular roles, whether it was with our previous call to action that we did prior to the election, some of the analysts that are on the front lines in Washington that help us navigate what's the unknown, what do we have to be concerned about as we enter this election of November 5th. And with that guidance, we were able to adapt and position ourselves and at least be educated on our next move. To here we are today with a new leadership, both in the House, the Senate, as well as the presidency. And what does that do and affect how we think and how we navigate with that uncertainty? But, why did we come together today here as we enter into one of the busiest weeks for folks getting ready for the holidays and the new year and year-end planning and all these deadlines? Why would we call us together today? Well, here we sit today with what I'm hearing from our clients, in that the market has done so well the last 2 years. Valuations seem to be a bit lofty or extended. Can we maintain this level? I'll tell you this, having worked through the 90s and having been through the bubble of the dot-com first chapter of the technological boom, I know and have felt the signs that lead us to that potential concern. And so what we are going to do is talk about it and address those concerns and address valuations. Here we sit today with a market that's trading 21 plus times earnings, which if you look back over the rolling 5 years, 19 times earnings has been the average price divided by earnings per share. And historically, we've been on an average of about 18 times earnings. So 21 times earnings is something to question and concern ourselves with, and how that could be interpreted and be effective to the future of market valuations. But we also have to look at the fact that earnings have been extremely strong this year, double-digit earnings growth, which that has to be, going back in my 30 years, one of the top 3 time frames where we've seen earnings explosive as they are. And here we sit today with the outlook of 11+% earnings growth per share for the next, call it, calendar year. Very strong numbers that we're looking forward to, as well as seeing in our rearview mirror. And then we also know that we have a Fed that has been very accommodating the last 2 years. But yet, Jerome Powell came out recently and said instead of lowering rates 4 times next year, we're thinking 2 times or a half a basis point. And that's something that's causing the market to react as early as this past week on, I believe it was Wednesday, when we saw the market dip quite substantially, which I think was overdue and well-deserved pause and reflect. But those are the facts that we have to navigate. And now we sit here with the new regime coming in January 20th to be exact, and all the things that we're hearing that come with that new regime. One, we hear the fact that we have the Republicans that will control the House, the Senate, and the presidency, which, as you may recall in our previous conversations, gridlock is our friend. Well, when we have a Republican House, Senate, and presidency, we realize that there's some potential changes coming if they can get the proper votes, whether it be involving immigration or the border or taxation and many other factors that they can potentially on policy evolve towards from where we're at today. And all of these factors. And you're hearing about crypto. And so what I do is I call upon folks that are trusted, that we've worked with for many decades, or if not years. And so I've asked Bob Carey, also referred to as Robert Carey, who's a CFA, a chief market strategist, someone that we have seen on CNBC. We've seen him in many different publications over the years, not only in print, but on the TV screen, that has come about to be an expert to leverage their thoughts at their institution, as well as his personal, both on the equity and fixed income markets. And I bring him to us today, like I have many others, because we're really interested to hear someone other than me, quite frankly, Bob. So we'd like to get your opinion on all of these uncertainties as we enter the end of the year. How much of the valuation should we be concerned about? How about the fact that the Fed is going to not lower interest rates? How about the fact that government spending is under scrutiny with this debt ceiling? How is that going to affect M2 supply and liquidity in the markets, which we've been living off of that enormous liquidity really since COVID, but maybe even prior? Bob, what do you see here? What should we be preparing for? How do we protect our clients, or how do we get them mentally thinking in the right ways without having emotion take over? Please.
Jeff, great to be with you again. Season's greetings. We certainly have a lot of things going on, as you outlined. I mean, we've had a great year as far as profits are concerned. I mean, earnings, as you said, are going to be up double digits, and as we plug in estimates for next year, looks like more of the same. And you couple that with a Fed that should get a little bit easier next year. I think you hit it right on the head that the other day we had a bit of a tantrum the other day. The stock market was not happy with what Powell said. Normally, the market celebrates when the Fed cuts interest rates, but it looks like this particular Fed would like to cut rates maybe a little more slowly than the market was hoping for. Of course, the market would love it if the Fed cut rates to zero quickly, but obviously that's not going to happen. We still have a bit of an inflation problem. I do think that inflation, I think you could argue, is the main reason that Trump was able to win this election. I mean, inflation has been a very big issue for a lot of voters. Inflation is down to 2.7% year over year as of last month. That is not the 2% inflation rate that the Fed sets as its objective. But at the same time, it's not the 5, 6, 7, 8% inflation that we had a couple of years ago. And I do think that the trend is heading in the right direction. But if you look at the numbers over the last 4, 5, 6 months, we've been kind of stuck at that 2.6, 2.7% rate, which means, we might not see those interest rates back down into the 2% range here anytime soon. And I think the market's beginning to reflect that.
Please have some water, Bob. I know this all makes us choke up at times.
I'm fighting a little bit of a cold here, of all things. But
are you in Chicago today?
Yeah.
Well, is that your state capital, the cold?
It is cold, and a lot of us have colds, no doubt about it.
Well, stay healthy, everyone here as well. And we've been hearing about that. So, the inflationary pressure we feel, I think one comment that I'll make is, one would say, wow, it's already down to 2.7, but we have to realize we're growing at a 2% increase on top of the growth that we've had the last 2 years. So that's
right.
It's not reverse. No one wants to see deflation. How about the big concern of productivity? I mean, inflation with no to productivity is stagflation. We know Japan dealt with that. How much of a concern do you have that productivity is under any major concern or stress that is new, or just something to keep our eyes on?
Yeah, I think the fact that we are spending as much money on technology as we are here in the United States, and not just the U.S., but abroad as well. But the U.S. really leads the world in technology implementation, development, and implementation. And I think that has been a huge benefit to us. Obviously, that's why the stock market has done so well. You look at the tech sector, it really is the main driver of equity returns over the last couple of years. And I don't think it's a coincidence that that's been the case because of the technology that we have. At the same time, we have seen regulations. We have seen, I would submit a lot of kind of quiet taxation, a lot of things that are not necessarily good for productivity have been in play. I'm hoping, and I'm sure you are as well, that we will see some streamlining of regulations here over the next couple of years. We've got basically a potential for fiscal policy to begin to help us a little bit as investors. The stock market tends to not do very well when we have very, very high levels of government spending. It's kind of the opposite of what many people think. But we've spent a lot of money the last couple of years. I think we've done well in spite of that. But I think one of the reasons that we have the interest rates that we have today above the inflation rate is the bond market is basically saying to the federal government, it's time to go on a bit of a diet. We spending has been very, very high as a share of GDP. We're running very, very high levels of deficits. The fact that we've got the 10-year Treasury at 4.5% in a 2.7% inflation world, those numbers were closer together 5 or 6 years ago before we had this massive surge in inflation. So I think the bond market anyways, is pricing in the possibility that we will not get our fiscal house in order, and there could be some surprises if we start to see spending as a share of GDP begin to come down a little bit. I think that would be helpful for the Treasury market. And if we can get yields closer to the inflation rate, that's obviously good for bonds, but I also think that would be good for equities in general as well. The stock market would like to see some certainty on taxes. I do think that's going to be, you touched on that, I think that's going to be one of the first orders of business for this new Congress and the Senate and the White House, is that we need to know what tax rates are going to be over the next couple of years. We have a sunset provision that kicks in fairly soon, and the window is here. We've got to see some action on that. Clearly, as investors, we want to know. We want to be able to plan. We want to know what taxes are going to be on estates and what they're going to be on capital gains, all of those sorts of things. Jeff, you deal with this stuff every day with your clients, and these tax rates have an impact on financial planning and on estate planning. And I think investors, if we get some certainty on that, if we get maybe a bump up in the estate tax, if we get some relief on capital gains, corporate tax rates coming down would be a good thing, I believe, for inflation. I know there's a lot of concerns about tariffs right now. A lot of folks are worried about the cost of things coming into the country going up. If you couple that with maybe some cuts in the corporate income tax rate, that is, disinflationary in effect. So I think that's Trump's play, is we're trying to make business maybe a little bit less cumbersome, regulations a little less cumbersome going forward, and the impact that inflation would have from tariffs would be muted a little bit if we were to get some regulation relief and some tax relief as well.
So if I could just maybe summarize, if you will, some of the points that you made. First of all, why is interest rates and the Treasury interest rates so much a factor as it relates to the economy and the markets? Well, first off, the equity markets are a direct correlation to the cost of borrowing. If we borrow money at a lower cost, it gives our ability to return to investors a higher margin, a kick, if you will. And then regulatory, that interest rate environment is something that we really keep an eye on when it comes to valuations. And when you have a lower interest rate environment, you have a more extended market versus the higher interest rates. We have a more condensed PE ratio or a lower PE ratio. So that's important to monitor. I think also the tariffs creating some type of a cost increase to the economy that we all would agree we're very hesitant to be involved in anything that's going to have counter activity to the inflationary taming. But you have to also consider other factors, and that is deregulatory environments, a more pro-business, energy independence, the cost of bringing energy to our call it country, and as well other forms of logistics, moving product across the country, let alone across the sea. The cost of energy is a direct correlation, and I believe the highest percentage of impact to a cost of a product that you're moving from one side to another. And so then you have the deregulatory, you have the logistics, and the cost of energy as a factor that is a major focus for the new administration. And then you have to look at the negatives potentially, and that is the tariffs that could cause higher prices. So if you weigh everything out, you may come to the conclusion that it's a wash, or maybe even the opposite. It's actually more favorable to bring inflation down and the deregulatory environment that we just can't really put a price tag on how that will impact. But we also have the ability, at least in this example, to look back prior to COVID of some of these policies. The approach, hopefully we all wish to be a lot smoother, and the execution, but I believe that's already shown signs that people have learned that are now taking the reins from what they had endured the previous go around over 4 years ago. But the impact that we felt going into unfortunate the COVID experience was far more appetizing to the lower inflation, the stronger productivity. So we're hoping. Would you expand upon that, Bob, any differently than I have, or extend any thoughts?
Yeah, inflation really is a very disruptive factor. It is, if you're a politician, the last thing you want to do is face the voters at a time where we have inflation running hotter than we would like. It affects. It might not affect necessarily high income earners, but for the average voter, for the average citizen, the middle class, the lower class, they feel the impact of higher prices. They might not necessarily be able to offset that with assets producing income or with higher wages, right away. Eventually they do, but that gap, if you will, in timing between prices going up and wages going up is problematic. And I think Trump understands that it would not be good for his administration. It would not be good for the prospects for midterms here in 2 years to have inflation running at a high rate. So I think that the concerns that many have expressed about tariffs driving inflation through the roof, I think he understands. I think he's trying to ultimately open up markets for our goods and services outside the U.S. There's no doubt about it. We are much more of an open book as far as being able to import things into the U.S. And I think that he would like to see other countries get more accommodative as far as our ability to send exports. And I think he's trying to really get the manufacturing segment, especially of the U.S. economy, back on track. If you look at the share of GDP that is in manufacturing, goods producing related areas, it has stabilized and over the last 4 or 5 years, and we've actually started to see some increases in productivity in that space. The one thing about COVID that really had to concern anybody running policy in the U.S. or anybody running a business in the U.S. had to be looking at the supply chain issues that we had during COVID. And all of a sudden you realize just how dependent you are on imports for a lot of critical items. And I think ultimately that it's a national security issue as much as it is anything else. And, it is in the end, obviously they're trying to do something that's good for the economy. But ultimately, I think, just taking a step back, the businesses, the companies that drive the economy, the companies that drive our economy, the stock market and all of that, today, if you look at where they are today, the one thing that has happened over the last generation is we have seen significant improvements in productivity. I think you're absolutely spot on for talking about that, Jeff, because it really is amazing how much more productive we are in the private sector today compared to, when I started my career, for example, in the mid 1980s. The two biggest retailers in the 1980s when I started my career were Kmart and Sears. Both those companies are gone. They took 6 months to sell all of the inventory in their stores. Twice a year, essentially, they turned over the inventory in their stores. Well, today we've got, companies like Costco and Amazon and Walmart that turn over the inventory in their stores once a month instead of once every 6 months. So the only way that you can do that is you've got to have an incredible logistics machinery behind you and technology driving a lot of that. And that, in the end, has driven up returns on capital across the board. For many, many years, the average company in the S&P 500 generated about a 6% return on all of its capital. So a 6% rate of return. And you think about where interest rates were in the 70s and 80s and even into the early 90s, we had a higher cost of capital than we had a return on capital. Obviously, we're in a much better situation today. I calculate that returns on capital today are north of 10% for at least for the S&P 500 companies in an environment where the Fed now has rates at 4.5%. So that difference between, essentially your cost of capital, interest rates, however you want to put it, and returns on capital has widened out to an historic high. And I think that's really the main reason we have the valuations that we have today in the stock market. We are selling, as you mentioned, we're 21, 22 times next year's earnings estimates, and obviously those estimates are just that. They're estimates, they're not guarantees, but it tells you something's going on. That the companies, the private sector, anyways. We can talk about government and government inefficiency and all those sorts of things, but the reality is our private sector is unparalleled in terms of its success and its expectations going forward. And we really do have the best companies in the world.
Well, I think, listen, if I can speak in plain English, which is probably one of my weaker suits, right? I would say the explosive of this chapter 2 of technology, which we're going to refer to today as AI, artificial intelligence, and how it's going to impact us is so unknown. But if we can reflect on the first chapter, which was the internet, and you just pointed out what's transpired for rate of return on capital goods going from 6% to 10%. That was because we became more efficient due to technology, more efficient in how we use technology. The fact that we're having a meeting like this, the fact that we are utilizing new technology that involves less cost in every form that we are operating on a daily basis. And if we can pause for a second and say, what does this next chapter bring as it relates to the same impact? First of all, we didn't have a clue of what in 1995 to 1999 this internet was going to do to us. We thought we did. We didn't. Let's be completely clear and transparent on that. We could always pretend on Monday that we knew who was going to win on Sunday, but we truly didn't on Saturday. I think this next chapter is going to be more explosive, more impactful, more violent in how it approaches the benefits that we feel in healthcare and logistics and communication and so many other ways that we like to think we know. We may know a little better because we're being put through the second, call it chapter of that. But the fact is the cost of capital and the cost of doing business is going to be reduced by this technology that you can't put a price tag on. I mean, our own government says if we're going to cut taxes, we have to put that against GDP dollar for dollar without saying what the impact is on the economy. Well, they're certainly not going to say, well, new technology, we're going to calculate on how it's going to impact the economy. So we're going in with well, this is the numbers, and it seems a little pricey. And the reality is there's so many variables that none of us can really put our finger on the impact it's going to bring. And I'm very excited, frankly, about 2025. I'm very excited about the next chapter of what this AI and technology is going to do for all industries and all companies that operate with the agile and ability to adapt to these changes in a way that's beneficial to us as a country as well as our experience. And then, of course, the profitability, which comes into play. And so I think that in plain English, you're just being very common sensual in that, guys, we're all caught up in what the numbers look like today, but we have to take into consideration the impact of things that we just don't know how it's going to play out, right? And please add to or detract.
Yeah, the one thing I would add to what you just said, Jeff, is that, whenever we have new technologies come on board and get implemented, there's no doubt that there are going to be some companies that are not going to be able to keep up. I think that's the one aspect of technology is it does force change, and not every company is able to change and adapt and survive. I think that's the one thing about a market-based economy is that just because we have a handful of companies right now driving the market, the perception is, hey, these are the companies that are always going to drive the market. And I would say you got to be careful of that kind of thinking. There are going to be some changes. You think back to how dominant some companies might have been 25, 30, 40 years ago. A lot of those companies are gone. So the technology, it is exciting, but I would just caution that it doesn't necessarily mean that all the companies that are successful today are going to be the ones that are going to be driving things going forward. Some of them will be, some of them won't be, and some of them will be gone. And every company eventually has its day where they fade away, and it could be obsolescence, it could be regulation. There's a lot of mismanagement. There's business schools are filled with these case studies around these things. So I think at the end of the day, it puts a premium on all of us to stay on top of things and to be really up on what's happening. I think I know a lot of folks the last couple of years their perception is, well, I'm just going to buy a couple of companies and just be happy with that and whatnot. And I think there's nothing wrong with that. That's been a pretty good place to be. But we have seen the market widen out over the last 6 months or so. If you look at the S&P itself, here in the second half of the year, the average stock in the S&P 500 has actually done pretty well, whereas the first half of the year, only about 1 in 4 companies actually was beating the market year to date through the middle part of the year. So the market is starting to widen out, and I think investors are beginning to look at other parts of the market besides the Mag 7, besides just the leading technology related companies. I think the opportunities are there. There's no doubt that asset allocation always comes into play. You've got some big gains in some of these names, and I think investors would be well served to, basically take stock of where they're at. I know you do a lot of this, I'm sure, with your clients, Jeff, where you look at allocations and you're like, are we overweighted in certain areas? We have too much concentration in certain things. I think that this is a time of year really to have those conversations as we prepare for the next couple of years. So the market, I think that, as much as anything, I'm probably more bullish about the average stock in the market than maybe some of the market averages, the indexes. I think these indexes have gotten a little bit top heavy. Valuations have gotten a little bit extended, and I'm looking a little below the surface, and I think that's where the money's going to be made over the next 6 to 12, 18 months.
Get a little bit more specific of what that below the surface. Where one of the things I'll just add to it is, 2 lines. One, Gretzky always looked for where the puck was going versus where it was. First, secondly, the emphasis of a portfolio in areas that have been working continuously typically isn't where it's going to work next. Some of the areas that have been underperforming this year have been healthcare recently, with the concerns with regulation with RFK. Energy has been under more pressure in the last half of the year. And so those are just 2 ideas of underperforming asset classes or sectors, if you will. I'm also going to just point out the fact that the value stocks, right? The companies that you're just not hearing about people bragging about. Going into June, July, the gap between growth, the companies we brag about and the ones that we don't talk about, the value was broad. It was almost a full double digits. And then
wider than anything I'd ever seen in my career, Jeff. I mean,
and then what happened in July? What happened in July, Bob?
We saw things completely reverse.
Growth came down and value came up. Growth came down double digits. Value went up 7%. And if you were sitting there in May saying, I'm done with these value stocks, I'm going into growth, you'd have been sorely impacted by that outcome. And our job is not to let that happen. But please, Bob, expand on that.
You hit it right on the head. There are, 6 style boxes if you think about it. You've got large, medium and small companies in the market, growth and value. And I would submit that most investors these days have got most of their equity allocation in one style box. 1 out of 6, they've got it all pretty much in large cap growth. Nothing wrong with that. That's where the shareholder value is being created. But at the same time, as we look at valuations and then we look at earnings estimates for next year, I think the mid cap, the small cap, selectively, I think some of the value side of the market, I think there's some attractive looking companies. I'll tell you one sector that has my attention right now that I haven't talked about in a really long time is utilities. Utilities are bonds, basically. If you think about what they are, these are companies that have defensive characteristics. They pay a dividend. The dividend goes up a little bit each year. The only reason to really buy utilities historically has been for defensive purposes or maybe for income purposes, more or less a bond substitute. Earnings this year for utilities will be up 20%. The S&P 500 utility sector is going to show better earnings growth this year than just about every other sector in the market outside of technology. And that I don't think I've ever seen before in my almost 40 years of looking at this stuff. And what's going on, this is where I say getting a little deeper. I think it is related to AI. I think it's related to all of these things.
I'm gonna interrupt, Bob, because this is beautiful stuff because of 2 reasons. One, we've been looking at the energy sector and building a sleeve to increase our exposure because of the demand for power. How do utilities and energy coexist and separate? How do we look at those in a different light? Because maybe we need to add utilities. Maybe there's an overlap. Maybe I'm missing something. Please advise.
Well, utilities are, more or less the in between, the raw. I mean, they obviously, for the most part, most of our electricity is produced with natural gas. It's good to have natural gas producers, and I do think that we are starting to export huge numbers of natural gas. We are the world's low-cost producer of natural gas here in the United States, but at the same time, we are building data centers like we've never seen before. We are bringing nuclear power plants back online over the next couple of years. That's a fascinating topic to think about. I think that basically the utility sector, those companies are the ones that are going to make it happen. They need to be able to, they need the infrastructure, they need the grid, they need all of these things to be improved. So, a lot of, you might look at, the AI related companies and you see some of these sexy companies, they might be a chip company, they might be a software company, but underneath it, they need
Energy.
some building blocks to make it all happen. And we have not spent very much money here in the last 30, 40, 50 years improving our productivity in the energy space. So that's what I'm looking for. I'm looking for things that are a little bit deeper. It's not necessarily the most obvious thing, but a couple weeks ago, maybe a couple months ago now, I was flying from Chicago. I was flying out east, and I had my Bloomberg up and running, and all of a sudden I see this headline pop up about 3 Mile Island.
Microsoft.
I was in high school when 3 Mile Island melted down, and we saw that thing get shut off, and we basically stopped building nuclear power plants pretty much at that point as a result of that accident. And the headline basically said that the owner of that asset is going to bring that asset back online over the next couple of years, and the expectation is that they were going to sell all of the electricity from just that one plant to one company, and it happens to be Microsoft, which is building and needs to build data centers like they've never needed to do before. So, there's a lot of exciting things. I think to me, I think the one thing about the end of the year here as I think about next year, just a lot of folks have, you look at the S&P 500, there's not a big weighting in energy stocks. There's not a big weighting in utilities. Utilities have done well this year. They've performed well. Valuations are less than the S&P 500, and we've got earnings growing faster than the average stock in the S&P 500. So to me, that's where you have the opportunities to make a little bit of money.
That's excellent. Many of you who've joined us today or maybe watching the retaping of this realize that, having been with us over the years, that we were in front of the call it semiconductor chips, call it explosion on the narrative as well as the performing revenue, and we were in it 6 to 9 months before we were even seeing the benefit. And the energy side we've been building upon. We paused going into the election because we realized, drill baby drill or not, we want to be not jumping into one category with involving energy more than we should. So we implemented it post November 5th. But we're really thinking the same thing, and I'm glad to hear we're at least on the right trajectory of thought, and then we're going to get into the granular aspects of that. But everything you just described, nuclear, data centers, natural gas, we have components within the, call it, demand for power for the AI to be relevant, and we know it will be. There's just no stopping it. And the infrastructure that it's going to take is going to be something we're going to look at very closely, because it may not be the energy company themselves. It may be the actual utility company behind the scenes building the infrastructure. So, Bob,
they're the ones making the investments, and utility companies have got to spend a lot of money to bring power online. And if we are, and I don't think the government is going to get in the way this time like it has in the past. I think that's the one aspect of the current environment going forward, is I think a lot of projects that would have been difficult to get done a generation ago, 2 generations ago, I think going forward, I think this current environment is going to be very, very good for those companies. I think they're going to be able to get things done that they would not have been able to get done before.
What you just said there, Bob, is important. Is the leadership in our country may have impact to how a company operates, and that's the deregulatory environment or the lack of government involvement that I think is going to be more relevant. I'm going to use an example, and those of you that paid attention the last month or two may have seen the exact thing that I saw, and that the spread between the 10-year Treasury and 30-year mortgage rates historically has been 1.5%. So if the 10-year Treasury's 4 or 5.5% is the 30-year Treasury. Or what's happened in the last 5 years and 4 years is that the spread between the 10-year Treasury and the mortgage rates were 2.5%. So instead of being 4% in the 10-year Treasury, we in a 5.5, we were at 6.5. And we all know that the 10-year Treasury's been higher when the 30-year mortgage hit 8% these last 12 to 18 months. What's happened since November 5th is that the spread has come from 2.5 down to 1 3/4 today. If you look at the 30-year Treasury the 10-year Treasury and the 30-year mortgage, the gap is all of a sudden, how does that happen? Well, I find it to be interesting that the banks were just pricing what they wanted to price, and now they're realizing there's a new sheriff in town and they better get back to the normalcy. That is, in my opinion, I watched it firsthand. I'm not going to make a guesstimate as to why it happened. I've got my instincts. I think you all do. But as it relates to the deregulatory environment and utility companies making investments with the concern of who's going to come a knocking and cause more cost for that investment because of regulatory environments, and I'm sure there's a good reason for it sometimes, but not all the time. These are things that are going to change and create deflationary environments. And those are the things that we have to keep in mind. And despite of ourselves, or in spite of ourselves, the technological advances that we're going to endure over the next 5 and 10 years are going to be explosive, and they're going to be so beneficial to operating and getting the job done for those that are going to be willing to embrace them, including companies domestically and abroad. And deregulatory, technological advances, infrastructure being propped up and improved. I'm hearing some outside the lines of conversation of sectors you like, utilities, energy. You're thinking it's more of a broad market versus a concentrated number of companies, which over the last several years we didn't see up until June, July this year. And I think that lends itself to diversification, making sure you don't have too high of a concentrated emphasis in the portfolio in any one company or any group of companies, which is going to be very tough to do in an environment where we know we're going to pay taxes. So understanding what the tax ramifications can be for selling highly appreciated positions and diversifying. These are things we're going to be focused on, Bob. Can I get some closing remarks? I'm almost at that 40-minute mark, and I know attention deficit is something I have to be cognizant of our audience and my own, for that matter. So I want to summarize and give us some closing thoughts as we close out the 2024 year and open with open arms the 2025 year. What would you tell our audience to best prepare them, if you would?
Hey, there's a lot of money sitting on the sidelines still. I think that's one of the more amazing things about this environment that we've been in that we didn't see in the second half of the 1990s. You know, that those late 1990s years, folks were in the market with both fists, both hands, both fists. They were all in, and we've actually seen money market fund assets go up this year by almost $700 billion. There's $6.7 trillion sitting in money market funds, and those rates are probably, in fact, they are coming down, and I would expect that those rates are going to come down even further here going forward. So, to me, there's opportunity out there. I think investors, you know, we all need to have our cash. We need to have our cash high enough that we can sleep at night. All of those sorts of things are always with us. But you know, I think the key is you got to have assets working for you. You've got to own things that are productive, that create shareholder value, create wealth. And you know, right now, I think there's some opportunities here, as always. And I think ultimately, you know, corrections happen. I think we got a taste of that the other day, as you mentioned. But at the end of the day, you know, the stock market is going to do what it's going to do. And you know, I think over the next 3, 5, 10, 15 years, I think investors are going to be well served by knowing what they own and why they own it, and making sure they own it at the right price. And that's, to me, that's just blocking and tackling. That's you know, whoever wins the Super Bowl this year is going to probably be the best at blocking and tackling. And I think investors are well served by having the same sort of mindset.
That last comment got me with the Detroit Lions, where I'm originally from, having no blocking and tackling due to defense being obliterated by injury. So I'm not sure how I take that, Bob.
Yeah,
but we did beat your Chicago Bears pretty soundly this weekend with no defense, just to be clear.
Yeah, the Bears. I'm just glad I grew up in 3 different places, Jeff. I'm glad that I have 3 teams I can rely on and not just one.
Diversity.
Yeah, I'm
having
diversified.
have enough cash to make it through the downtimes, because there will be a downtime. We will have a correction in the next 2 years, without doubt in my mind.
No.
And being able to dollar cost average into the markets with discretionary income, being able to sustain the cost of living for us for the next several years in an event of a market correction that's longer than the average of a year. And then making sure you're diversified relative to the longer term category, which is equities, as well as longer term fixed income, and mitigating against duration risk and credit risk, making sure you've spread it out. I have the benefit of working with new wealth, and I have the benefit of working with generational wealth. And the new wealth needs to learn from the generational wealth. The new wealth thinks got to hit grand slams constantly. The generational wealth knows in order to stay in the game, you have to have consistency and you have to live within guardrails. And so my job is to communicate how we get the fire of a new wealth, but yet the thought process of the old wealth, because I do think there's some strengths and weaknesses on both sides. And I tell you this, here we are today entering the next year, thanking everybody for the opportunity to be a part of their team, an extension of their, we call financial quarterback or CFO, from their family and as well as their businesses. And I wish everybody the most wonderful holiday season to get regenerated, get refocused, and set goals. Write down what we want to achieve in the next year and help us be a part of meeting those goals. And I thank partners like Bob and my team for making us number 22 in the nation by Forbes of all advisors across the country, independent or employees of these major firms, and ranked number 1 in Michigan and number 2 in Florida most recently, up from 24 and equal to what we were last year for the states. And so it wasn't for my team, it wasn't for our audience. If it wasn't for partners like you, we would not have that proud accolade to lean ourselves against at the end of a year when it's been so demanding to make sure we're on top of things. And I welcome everyone back next year, where we're going to make it the best year yet. And I want to remind us, we don't just survive, but we thrive with folks like you, Bob, and the audience that we have the opportunity to work with. So be well, and we'll see you soon.